Hey realtors, it's time to wake up. Your investor clients are standing on the edge of a rental catastrophe that may look like opportunity on the surface. What's happening in Canada's rental market right now can either ruin your clients' portfolios or become the biggest opportunity of your career if you actually understand it. In Vancouver, the average renter is paying about $2,900 a month in rent. In Halifax, it's over $2,100. In Toronto, it's around $2,600. In most cities, rent alone is eating more than 35% of household income. And when you add other debt, the typical renter is burning over 40% of their earnings just to stay afloat. So that great tenant your investor just signed, well, they might be one interest rate hike or one job loss away from default. So here's a question for you. If your top investor called you today and asked you, hey, is it still safe to buy a rental property in this market? Would you honestly know how to answer? The median Canadian renter today is about 32 years old, working full-time, and increasingly a long-term renter, not a future buyer. About 12% are raising kids and roughly 28% have pets, which means more wear and tear, longer stays, and higher expectations from their housing. In places like Winnipeg, the family renting capital, the median renter is in their mid-30s, and more than 1 in 5 have children, and yet those same markets show some of the highest rates of bankruptcies and collections in the country. Cheaper rent doesn't automatically mean safer tenants. It often hides deeper financial stress. Oh, and by the way, this just isn't a demographic trivia point. It's a flashing signal that Canadians are relying on renting for longer, and they need professionals who can navigate that reality. Single Key's 2025 data shows the average renter earns about $67,000 personally and about $109,000 per household. But when rent and other debt payments total around $2,700 a month, over 40% of their income is gone before groceries, gas, or savings. On paper, the average credit score around 693, well, that looks fine. But central and lower cost regions are getting hammered with higher bankruptcies and collections. Meanwhile, in BC and Ontario, landlords are approving only about 75% of applicants because screening standards have tightened so much. So if we're talking about stable cash flow, if your investor doesn't understand these numbers, their cash flow is fragile. If you do understand them, you can help redesign their strategies so that cash flow is actually sustainable. At the same time, Canada is building an unprecedented wave of rentals. More than 80% of all housing units under construction right now are apartments, purpose-built rentals heavily backed by CMHC financing. CMHC's 2025 updates show rental vacancies climbing to the highest level in years as this new supply hits the market, slowing rental growth while operating costs keep rising. So investors are being squeezed from both ends. Tenants under financial pressure and a market with a flood of new rental competition. This isn't the old rentals are always a goldmine story. It's a structural shift that can either wreck portfolios or reward the realtors who understand it and help clients adapt. Right now, are you just pitching it will always rent? Or are you the one person in the room who can show investors where that story breaks and how to pivot? Here's what most agents are missing. When renters are spending 35 to over 40% of their income on housing, they spend less in the broader economy. Less spending means weaker local businesses, more job risk, and fewer qualified buyers for your resale listings down the road. At the same time, families are renting longer, well into their 30s and beyond. So the old rent in your 20s, buy before kids pipeline, well, that's breaking down. If your entire business model depends on a big wave of first-time homebuyers showing up to rescue your GCI, you may be waiting a long time. But for the realtor who understands renters and investors together, well, this is where your value explodes. This can be the bridge between stressed tenants and smart landlords who want sustainable win-win solutions instead of quick, fragile wins. So as a realtor, what do you do with all this? Well, you stop treating renters as background noise and start treating renter data as a core investment metric. You master rental profiles and screen beyond, do they qualify today? You look at debt loads, income sources, and regional risk. You help investors pivot towards more resilient plays, multifamily in markets where rent-to-income ratios are still sane, value-add renovations where you can improve quality and justify strong but sustainable rents. and you introduce alternatives like rent-to-own or shared ownership or small multi-unit family strategies that give renters a path while giving investors long-term realistic returns. Most agents will keep pretending that this is business as usual, but those agents will lose trust when their clients face vacancies, evictions, and cash flow shocks that they never saw coming. The smaller group of realtors who can understand this shift and can explain it clearly become indispensable. If you're watching this thinking, I've been selling rentals without really understanding the renter or the numbers, well, that's not something to be ashamed of, but it is your signal to level up. Inside the Real Estate Investment Specialist training, this is exactly what we work on. How to read rental data, how to stress test cash flow, and how to build investor strategies that can survive the next 5 years, not just the next 5 months. If you want to be in the small group of agents who see this coming instead of the 93% waiting for the market to recover, hit the link below in this video. Canada's rental bomb is ticking louder. The only question is, will you be the one who warns your clients and help them adjust, or the one that they blame after it explodes? Please like, share, and subscribe to get this info to more people who need to hear it, and I'll see you in the next one.